Happy Saturday, you guys. See this face? This is a face that is happy to talk about insurance. What? No, I want to share about Financial Peace University FPU class number 6, which is about the role of insurance in your life. And I gotta tell you, this is one of my favorites. One of the biggest myth busting ones. Second to the fact that you don't need credit or credit score to live. Hallelujah for that. So the role of insurance. So your offense is building money, building wealth, and your defense is saving money, cutting back, and insurances to protect you. So insurance is supposed to cover the little things that you can afford, like a tire blowing out and having to replace a tire, or a doctor's visit, or an annual visit to the doctor. And you're supposed to be able to take care of the little things, and you insure the things that you can't afford to take care of, like replacing the whole car if you don't have an emergency fund in place, or cancer or something like that, life-changing disease that would be millions of dollars in medical bills. So here's the deal. We'll just run through them. Healthcare, as you know, as you have more money, if you have your emergency fund, you could go higher deductible. That's how you save on your premiums, period. And honestly, that's where you should be. That's what rich people do, is high deductibles. They don't pay a lot out in premiums, and they pay for the small things like going to the doctor. Right now our deductible is $5,500 a year, and I can't wait till the day that I could cut my premium payment in half and have a $10,000 deductible. Actually, I think it's $10,500 now. They raised it to $500. $10,500 deductible, because we have an emergency fund. So if we gotta go to the doctor, even if I have another baby. I had a C-section last time because it was an emergency, but Jordan, it cost us $4,000. We paid for it. We paid for it cash. Went through a birth center. We paid for it cash. So you basically budget and plan for the things that are yearly visits and so forth, and you pay for those. And if you have an event, like somebody breaks their arm, that's probably going to be 20 G's. Because, that's how medical is. 10 G's something come out of your pocket. The other 10 G is paid by the insurance. And anything after that's paid by the insurance. So what I use is actually like an alternative to insurance. It's called MediShare. And it's basically a Christian bill sharing program. And I love it. And they've been great. The only thing difficult with them is when you want to get reimbursed. Like you paid it out. But when it comes to hospitals and anybody sending them a bill and getting paid out for, like, once you pass your deductible, they do it immediately. The check goes in the mail like in a couple of days. And so, like, as I was mentioning, not a lot of people know, and I have to do a whole nother video on the whole story at some point. But with Riley, we did the same thing we did with Jordan, paying the prenatal and the birth center, whatever. And when I was going through labor, we were actually going to give birth at home, right here, where I'm sitting. And it was going to be beautiful and basically birth with a view. That's what I was saying the day of when my water broke. But Riley had other plans. She had flipped and she was coming feet down. And there was a foot in the birth canal when the midwife came to check me, so we had to get in the car, rush to the hospital. Anyway, I say all of that to say the $4,000 with the prenatal and the birth and a couple doctor visits, we already hit our deductible last year, which was $5,000. They've upped it $500 more, but it was $5,000. We hit that deductible, and the hospital sent bills. My C-section was $18,000. They ended up negotiating it down to $12,000, but they sent the bills and Medicare paid everything. So I've had a really good experience with them. But yes, so basically you insure what you can't afford or what will make you go bankrupt. You let, and if it makes sense with your dollars, if it's not too expensive, you let others take on that risk. Life insurance. This is a big one that people get all wrong, and mostly because we've been sold a lie all this time. So most people have whole life. Whole life insurance or cash value insurance is those that basically you pay a premium for however long you pay it, and you end up having a death benefit, whatever it is, the amount, if you die, before you retire or whatever. But if not, when you retire, you have cash value, you have money, so like a savings plan built in. But these whole life policies have a horrible rate of return, and you could do much better with your own cash in your own mutual funds, in your own investments. So the suggestion is to never, ever, 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 ever get whole life. Like, you don't need something to pay you till the day you die. Like, no, you need a game plan to build wealth. And when you have wealth, you're self-insured. So it looks like this. You get term life insurance, which I'll explain it in a second, to cover you for your working years or while you're building wealth. We'll talk about it in a second. But if you do the Dave Ramsey plan, you get out of debt. Then you build your emergency fund. Now you have money in place just in case anything happens. Then you invest in retirement. You start paying your house off early. If you have kids, you pay towards college. The statistics are that the people who do the Dave Ramsey plan, the average, end up paying off their house in 7.5 years. So, who the hell needs life insurance for their whole life? If you get out of debt and you have a paid off house and you're investing in retirement, you're going to have money. The numbers also say that a typical household that makes I think it's like 50 to 70 grand. A typical household doing all the things Dave Ramsey says, in 20 years will have $700,000 to $1 million in mutual funds. So in 20 years, you have $700,000 to $1 million. Let's say you have $1 million. That sounds like a person who's self-insured. So what do? While you're building this wealth for 20 years, you get term life insurance. So term life insurance is a really, really low monthly payment to protect you from now for the next 20 years, from now and the next 15 years, whatever it is that your math and what you're comfortable with, that you decide on for you to be protected until you self-insure. And honestly, guys, who wants, first of all, insurance is a bad investment vehicle. And who wants insurance to take care of you instead of you take care of you? Make money. Make your money. So here are the numbers. He ran through an example. I'll say it off the top of my head. Hopefully you'll get it. I could even take a picture of it. In fact, I will. And I'll add it after I explain it so that you can have a visual. So basically, oh wait, do I have it in the book? I think I have it in the book. If there's no picture, my apologies. But if there is, I'll split this video and put it. So basically, the example has a guy named Joe, and for a $250,000 whole life cash value policy, Joe pays $178 a month, and he's 30. And if he would get the same policy in term for 20 years, so 30 to 50, he would be paying $13 a month. So the example is, you pay $178, and by the time he's 50, he'll have $34,000 if he wants to pull that money out. It had a rate of return of 3%. Horrible. If he goes with term, he pays $13. That means he has $165 left over for him to do whatever he wants with it. And if he puts it in good growth mutual funds, he would have, instead of $34,000 at age 50, I think it was $100 and something thousand at age 50. Okay, just there tells you, oh my gosh, that's way more money, better rate of return. Okay, then fast forward 20 more years, at age 70. At age 70, the cash value policy would have $124,000 in it. And at age 70, the $165 he took that he didn't spend on cash value on top of the term life or whatever, if he continued going on with those $165 a month, putting it in there, he would have, in his mutual funds, he would have almost $2 million. $2 million to 125. Hello? The numbers say it all. So it's a ripoff. So what if you pay $13 a month for 20 years and get no money back? You did way more with the other money. So it's a gimmick. It's a gimmick to get a policy that's supposedly going to give you money guaranteed at the end, because it has a bad rate of return and you could do better without it. So the whole point is, get term life for your family, and the rules are you're supposed to get 10 times your salary. So like, if you make $50,000 a year, you get a $500,000 policy, 10 times your salary. So in the event, God forbid, something happens and you pass away, your family would get $500,000 to invest and replace your income at a 10% rate of return at least. Replace your income. So they'll be getting $50,000 a year, what you were making. So that's the strategy behind it. Get the term life while you build wealth to protect you. Once you have wealth, you are self-insured. So your goal should be, how do we get this money? How do we get out of debt? How do we save our emergency fund? And now let's start investing. Let's pay off our house and let's be debt free. How much money would you have if you've had no credit card or student loan payments, no house payment? How much money would you have? What would your life look like? What could you do? Think about that. What else with the insurance? Car insurances, again, high deductible, and lower your premiums as long as you could afford it. You got an emergency fund, you could get rid of comprehensive and collision if you want to. However, you can still have a break-even analysis and do some math over a certain number of years. Like, how many years would you need to go without having an event to make it worth it? Because there's a pretty competitive rates out there. If you're paying $75 a year to go into a higher deductible, the loss of protection you get might not be worth it at the end of the day, and you just pay it. But the whole point is, always think high deductible, low premiums. You take care of the little things with health, car, whatever, and you insure the big things. So optimizing your insurances, your insurance needs. If you want any further detail, like I could get deeper with the car one. In fact, you know what? I'm probably going to do a specific video on each one at some point. Probably show you our car coverages. Oh yeah, one last tidbit. You want to always have high liability protection. So in your car, auto, for example, you probably have too low of liability. Liability is one of the cheapest to cover, like one of the most important, because if you get into a bad wreck, something that's your fault, and people get hurt, they're going to sue you. And liability protects you from that lawsuit, will pay out. So you want the highest possible, which is $500,000 payout. So you want the highest possible in your car insurance and your homeowner's insurance for liability. And once you really start building wealth, there's further liability you could get, which we could talk about another time. But basically, that's insurance. You need to pay less on the things you don't need, pay a little bit more on the things you need, and basically optimize it and get term life. Cancel your whole life insurance. Cancel it. But wait till you have your term life in place before canceling it, because you don't want to be in trouble. Alright, that is all. Have a great Saturday. Thanks for listening. And I love talking to you guys. Bye.